In this video, I'll explain exchange-traded funds or ETFs and how you can use them to invest and grow your wealth. And we're starting right now. Hey, what's up everybody, and welcome to another video from the Keystone Financial Academy. My name is Elliot, and if you're new to this channel and you're interested in finance, investing, and real estate, I invite you to join our community by subscribing and turning on notifications so you don't miss any of the upcoming videos on these topics. Okay, so let's talk about exchange-traded funds or ETFs. Now, to understand ETFs, it really helps to understand mutual funds because these two financial instruments are alike in a lot of ways. If you want to get familiar with mutual funds, by the way, I have a detailed video on them and I'll leave a link in the description below, but in the meantime, let me go through a quick review. A mutual fund is a pool of money from many investors used to purchase securities such as stocks. You buy shares in the fund and then you invest in whatever stocks the fund owns. If it's a managed fund, then a fund manager will pick the stocks for you. If it's an index fund, the stocks will be tied to an index such as the S&P 500. So an ETF is very much the same. It is also a pool of money for many investors, and it also buys stocks which you are now invested in as a shareholder of that ETF. So what exactly are the differences between a mutual fund and an ETF? Well, there are a few. The main difference is that an ETF behaves more like a stock than a fund. What that means is that there's no minimum to invest and you can buy just one share of an ETF. ETFs can also be shorted and bought on margin, which just means using borrowed money from a broker. This is something you can't do with a mutual fund. ETFs are also liquid and can be traded very easily. So you could arguably look at an ETF as an improved version of a mutual fund. ETFs started their life and became famous for low-cost tracking of indices. In fact, the very first ETF in the US, and still the most widely known and traded one, the SPDR S&P 500, or SPDR as it's known, is an index fund that tracks the S&P 500. The second biggest ETF in the US, the iShares Core S&P 500, also tracks the S&P 500. ETFs in general are relatively new kids on the financial block, first appearing in 1990. 30 years later, they've become quite popular with over 5,000 ETFs available worldwide and nearly 5 trillion in combined assets under management. Here in the US, there's over 1,800 ETFs available and about 3.4 trillion in combined assets under management. Just like with mutual funds, you can have all sorts of ETFs, and really the sky's the limit here. When most people discuss ETFs, they're talking about market ETFs, and those invest in index stocks. You can also invest in bond ETFs, commodities ETFs, and foreign ETFs, among many others. There are some managed ETFs as well, and those can invest in a certain industry or a certain sector, or they can have completely their own unique style or investment approach. And as you may imagine, a managed ETF is probably the closest you're going to get to a managed mutual fund. Now, as an investor deciding if ETFs are right for you, you might be interested in some of the advantages and disadvantages of investing in them. Here are a few advantages, and if you know index funds really well, you're going to recognize all of these. Advantage number one is low fees. This comes with the territory of being a passive index tracker, and this is something all such ETFs have in common with index funds. The average index ETF carries an expense ratio of 0.2, and many charge even less. Advantage number two is diversification. This also comes with the territory of any ETF or mutual fund that tracks a major index. If your ETF is tied to the S&P 500, you're investing in over 500 stocks from a variety of sectors and industries. Advantage number three is low entry threshold. This is a major ETF only advantage over most mutual funds. If you check around, most desirable mutual funds have a minimum initial investment that can range from $1,000 to $10,000. Not so with ETFs, you could just buy one share to get started. Advantage number four is taxes. Index ETFs, just like index mutual funds, incur far less capital gains because they sell far less stocks and don't turn over as much. And finally, advantage number five is liquidity, transparency, and simplicity. A significant benefit is that major ETFs are very liquid, which means it's very easy to buy or sell them, and their holdings are fully transparent. They're also simple, user-friendly, and combined with the low fees makes for a really good entry point for a beginner investor to start investing. Now, you may have noticed these advantages apply to index tracking ETFs, and the positives do diminish if you invest in a managed ETF. The two advantages that do remain if you go for a managed ETF is a low entry threshold and the ability to short the ETF and buy on margin, which probably won't interest most long-term buy and hold investors, but it may interest others. Now here are a pair of disadvantages to ETFs. Disadvantage number one, lack of targeted investing. Since there are much less ETFs out there than there are mutual funds, you may not find exactly what you want if you're looking for a very specific or a unique investing opportunity. Most ETFs track major indices or large cap companies, so if you're looking for something a little more exotic, you'll have to seek out a specialized mutual fund instead. Disadvantage number two, you won't beat the market. This really applies to all passive indexed investments. You'll do as good as the market, never better, but also never worse. Purchasing ETF shares is identical to purchasing shares of any stock. You simply log into your account with your online discount broker, research and pick out the ETF that you're interested in, and purchase as many shares as you wish to purchase. So which ETF do you pick if you're looking at dozens of ones that, let's say, invest in the S&P 500? Well, you first identify the top 5 or 10 with a little bit of research, and then just check which one has the lowest expense ratio and invest in that one. Here are the top 5 biggest ETFs by assets under management from last year. The first one is SPDR S&P 500 ETF. It's nicknamed the Spider, and its ticker symbol is SPY. The second one is iShares Core S&P 500 ETF, and its ticker symbol is IVV. The third one is Vanguard Total Stock Market ETF, and its ticker symbol is VTI. The fourth is Vanguard S&P 500 ETF, and its ticker symbol is VOO. And finally, we have the Vanguard FTSE Developed Markets with a ticker symbol of VEA. So write these ticker symbols down and research them on either Google or Yahoo Finance or your discount broker research tools and see which ones are the cheapest to own. And also check how expensive each share is. It's really as simple as that. As a quick research example, we'll take a look at the very first ETF on that list, the SPDR S&P 500 ETF with the ticker symbol of SPY. Here it is to the TD Ameritrade interface. As you can see here, its current share price is $332.80, and it has an attractive expense ratio of 0.09, which means it'll cost you just $9 if you invest $10,000. Other than that, the ETF has followed the S&P 500 with all of its ups and downs it has had in this very eventful 2020. Okay, so that was a quick primer on the fundamentals of ETFs, and hopefully you understand them better now. As always, be sure to subscribe, hit that like button, and let me know in the comments below what future topics you would like to see me cover more of. Thanks for watching, and I will see you all soon.